Welcome back to another Explainer. Today, we're tearing into a fascinating company that has been showing just absolutely phenomenal momentum in the market. We're talking about the Chef's Warehouse, trading under the ticker symbol CHEF. Now, on the surface, this company is firing on all cylinders. They're boasting massive growth and executing their strategy flawlessly. But if you look under the hood, there are some major, flashing valuation warnings that the broader market seems to be completely ignoring. So today, we're going to break this stock down to cover all the key points, using a strictly objective analytical approach to see what's really going on. And remember, we're just looking at the math today. This is an educational explainer, not financial advice. Okay, let's dive into this because this is the central mystery we're trying to solve today. When a stock runs up as incredibly fast as this one has, we really have to ask ourselves, is this upward trajectory sustainable because the underlying business is just that good? Or are we looking at a classic value trap waiting to spring on unsuspecting investors? Basically, is it priced for perfection or disaster? To set the stage, we've got to talk about this massive disconnect. You've got the current stock price trading right around $110. But then you look at the estimated intrinsic value from Guru Focus, which is basically what the raw math says the business is actually worth, and it's sitting way down at roughly $53. The metrics suggest that this stock is trading anywhere from 76 to 106% above its estimated intrinsic value. That is a massive chasm. It sets up this perfect courtroom trial narrative for us. Incredible operational results on one side, and a gravity-defying valuation on the other. Here's the game plan for today's explainer. We'll start with the setup, move into the bull case, flip it over to the bear case, run it through the Guru gauntlet, and wrap up with the final verdict. Let's kick things off with part one, the setup. Before we judge the numbers, let's look at the business itself to understand exactly what they do. The Chef's Warehouse is a $3.1 billion specialty food distributor. They serve premium restaurants and hospitality clients all across the US and Canada. We're talking imported cheeses, specialized cooking oils, high-end chocolates, premium meats, the whole shebang. They've built a genuine niche moat based on a heavily curated product assortment and highly sophisticated logistics that are optimized for fresh, perishable goods. And wow, the market has rewarded them for it. The stock is up over 100% from its 52-week low of roughly $53. Moving right along to part two, the bull case. That incredible run brings us to the defense. Let's see exactly why Wall Street is generating so much excitement over this stock. These are the 7 green flags, and I have to admit, they're undeniably impressive. In Q 2026, their earnings per share beat estimates by a massive 22%. They drove 12.9% revenue growth, hitting $1.17 billion for the quarter alone. Because of this phenomenal momentum, management actually raised their full-year revenue guidance to between $4.5 and $4.6 billion. On top of that, their gross margins expanded by 53 basis points to 24.3%. And their adjusted EBITDA, essentially their core operating cash profit, surged an incredible 35% year over year. Add in that genuine niche moat with premium culinary clients, plus a Guru Focus score of 78 out of 100, which indicates strong long-term potential, and you can absolutely see why the bulls are charging right now. This is a company showing exceptional execution. But let's flip the script. Part 3, the bear case. As any good investigator knows, you have to look at both sides of the coin. Let's hear from the prosecution. The metrics strongly suggest that this stock is dangerously stretched. Guru Focus officially rates it as significantly overvalued, which is one of their most extreme labels, and there are 6 to 7 distinct warning signs flashing right now. For starters, the company is carrying high leverage. They have a debt-to-equity ratio of 1.61, which is a major risk in a high-interest rate environment when debt refinancing comes due. Furthermore, the price-to-gram number is sitting at an extreme 7.11x. That means the stock is trading at over 7 times what a classic conservative valuation model says it should be. And if you run the Peter Lynch fair value model, it actually implies a 24% downside from where we are today. But perhaps the most jarring piece of evidence for the bear case is this single number, $18.3 million. That is the exact amount of stock that corporate insiders, including the founder and CEO, have sold over a recent 3-month period. And the amount of insider buying during that exact same period? Zero. Absolute zero. Crickets. Look, when executives are unloading nearly $20 million in stock into a massive rally without buying a single share, it's a glaring cautionary signal for us external investors. Now, what's really interesting about this next point is the reality of their profitability. We have a gross margin of 24.3%. That looks okay on the surface. But then you look at the net margin, and it sits at a microscopic 1.87%. This is a razor-thin buffer. In the incredibly complex logistics of specialty food distribution, a net margin below 2% leaves virtually zero room for error. If inflation bites even a little bit, or logistics costs spike, that profit could vanish instantly. Which brings us to part 4, the Guru Gauntlet. So we have hypergrowth on one side and extreme valuation on the other. It's time to settle this with the ultimate stress test. We're going to run this stock through the absolute objective rules of 3 investing legends. First up, the father of value investing himself, Benjamin Graham. Notice this absolute sea of red X's. Graham's conservative limit for a price-to-earnings ratio is 15. The Chef's Warehouse sits at a towering 44.12. The price-to-book? Fails. The debt-to-equity? Fails. And that price-to-Graham number of 7.11 means it's trading at over 7 times what Graham would consider a conservative intrinsic value. So this stock catastrophically fails Graham's absolute rules. Next, we run it through Peter Lynch's growth at a reasonable price framework. Now, the earnings growth is definitely there. They've got a projected 16.2% growth rate, which is great. But Lynch's golden rule is that a company's PE ratio should roughly equal its growth rate. You want a PEG ratio of 1.0 or less. But at 44 times earnings and 16% growth, the PEG ratio is way up at 2.72. The price simply does not justify the growth. So it fails the Lynch test too. Finally, let's look at Warren Buffett. This is a business Buffett could easily understand. Specialty food distribution is right in his wheelhouse. But look at the actual returns on capital. Buffett wants a return on invested capital of 15% or more. Chef is only at 7.6%. He looks for gross margins above 40% to indicate a highly durable competitive advantage. Chef is hovering around 24.3%. So while they're profitable and definitely have a narrow moat, the financial returns on capital are just way too low for his framework. Strike 3. It fails the Buffett test. That leads us nicely into part 5, the final verdict. We've seen the operations, we've looked at the valuations, and we've run the gauntlet. Let's summarize this tug-of-war objectively. The bottom line is that the Chef's Warehouse is undeniably a high-quality operational story. I mean, 12.9% revenue growth and a 35% EBITDA surge, that's fantastic execution. However, it's trading at an extreme premium valuation. It is unequivocally rejected by the classic frameworks of Graham, Lynch, and Buffett. Plus, that $18.3 million in one-sided insider selling is a major cautionary signal. Ultimately, based on these historical frameworks, an objective investor might just keep this one on a watch list and look for a significant pullback, ideally back down toward that $53 to $80 range rather than paying today's heavy premium. And honestly, this brilliantly illustrates a timeless investing truth. As Warren Buffett famously said, price is what you pay, value is what you get. Right now, at roughly $110 a share, you are paying a massive premium for the value you're actually getting in return. So I want to leave you with this final thought to ponder. Can their double-digit revenue growth and margin expansion continue long enough to actually grow into this massive valuation premium? Or is a sharp correction simply inevitable when that growth eventually slows down? I really want to know what you think. Make sure to hit that subscribe button so we can keep learning together, and drop your thoughts in the comments below. Does the incredible growth justify this price? Thanks for joining me for this explainer, and I'll catch you in the next one.